What if I told you that two identical $20 bills feel completely different to your brain, and that difference is quietly draining your bank account every single month? Here's something nobody tells you about money. Your brain refuses to treat it as one single pool of resources. Instead, it builds these invisible mental compartments, little psychological wallets, and it sorts every dollar you touch into one of them. A dollar earmarked for groceries doesn't feel the same as a dollar you found in an old coat pocket. A tax refund doesn't feel the same as a paycheck. And here's the uncomfortable truth about your money brain. It behaves differently depending on which invisible wallet the money came from, even when the math is exactly identical. This mechanism has a name. Economists and psychologists call it mental accounting. The plain version: your brain keeps separate emotional ledgers for different pots of money, and those ledgers do not talk to each other the way a rational spreadsheet would. Richard Thaler, the Nobel Prize-winning economist, identified and named this in the 1980s, and decades of research since then have confirmed the same basic finding. Humans are not consistent about money. We are deeply, predictably inconsistent in ways that cost us real dollars. Now, why does this matter for you right now today? Because mental accounting isn't just an interesting quirk. It's an active force inside your financial decisions. And once you see the mechanism clearly, you will start recognizing it everywhere. In your own habits, in how companies price their products, and in the financial choices you've been quietly rationalizing for years. So stay with me, because the first story I'm about to tell you might feel uncomfortably familiar. Picture someone named Marcus. He works a steady job, watches his budget carefully, packs his lunch most days. Marcus is, by any reasonable standard, financially disciplined. Then in March, he gets a tax refund. $1,100 lands in his account, and something shifts. Within 3 weeks, the $1,100 is gone, a weekend trip he'd been putting off. Marcus didn't blow his paycheck. He blew his refund. And in his mind, those two things are completely different events. This is mental accounting doing exactly what it's designed to do. Marcus's brain filed the refund into a separate psychological ledger, one labeled something like bonus or found money, and money in that ledger carries a different emotional permission slip. It doesn't feel like the money he worked for. It feels like it arrived from somewhere else, which means spending it doesn't carry the same psychological weight. But here's the thing. That $1,100 was earned. Marcus overpaid his taxes all year in small increments, and the government returned his own money to him. There is no mathematical difference between that refund and $1,100 from any other paycheck. The difference is entirely in how his brain categorized it, and that categorization changed his behavior completely. This is the mechanism at work in its most visible form. Windfalls, bonuses, gifts, gambling winnings, cashback rewards. Your brain files all of these into a loose money ledger, and the rules for spending that ledger are much, much looser. You'd never drop $1,100 on impulse purchases from your regular account, but from the windfall account, somehow it feels fine. Now here's where the story gets darker, because mental accounting isn't just something that happens to you passively. It's something that sophisticated businesses have learned to engineer deliberately. And once you see it, you cannot unsee it. Think about how casinos work. You walk in with real cash. But you don't play with cash, you exchange it for chips first. That one step is not about logistics, it's about mental accounting. Chips don't live in the same psychological ledger as dollars. They're abstract, they're colorful, they're game pieces. And research consistently shows that people bet more, lose more, and feel less pain spending chips than they would spending the equivalent in actual cash. The casino has hacked your mental ledger on purpose. Now bring that same logic into everyday life. When you tap your phone to pay for something, your brain processes it differently than handing over physical bills. When a subscription charges you monthly, you file it as a small recurring cost rather than what it actually is, a significant annual expense. $79 a month sounds reasonable. $948 a year sounds like a decision you should probably think about. Same number, different mental ledger, completely different emotional response. Credit cards are perhaps the most powerful mental accounting tool ever invented for the retail industry. Spending on credit doesn't feel like spending real money. It's spending future money, which lives in a different ledger entirely. Studies have shown that people consistently spend more, sometimes significantly more, when paying by card versus cash, not because they are richer, but because the money comes from a ledger that doesn't trigger the same spending pain. Your brain registers the purchase. It just doesn't register the loss. Let's slow down here and put a real number on this, because this is where mental accounting stops being an interesting idea and starts being something you should be genuinely concerned about. Consider that it's only framing, one of the most common mental accounting moves most people make without even noticing. It's only $5 for coffee. It's only $15 for the streaming service. It's only $20 for the monthly app subscription. Each of those purchases lives in its own tiny mental ledger. Each one evaluated alone passes the "is this worth it" test easily. But your brain never adds the ledgers together. It evaluates each one in isolation. $5 a day on coffee is over $1,800 a year. Add the streaming services, the apps, the subscriptions you barely use. For many people, the total runs somewhere between $2,000 and $4,000 annually in spending that never got evaluated as a whole number. Now compound that. What would $3,000 a year, invested consistently over 30 years, actually become? At a conservative average return, you're looking at a number that would make your current self genuinely uncomfortable. The money isn't gone because you made one bad decision. It's gone because your brain kept evaluating tiny ledgers instead of the total ledger. And this is the mechanism that hurts long-term savers more than almost anything else. Retirement savings live in a future mental ledger. Spending temptations live in a now ledger. The now ledger always feels more real, more urgent, more immediate. So the future ledger gets rated, delayed, or ignored, not because you don't care about your future self, but because your brain literally files that future self in a different account. All right, so here is the part where I give you something you can actually use, because the goal isn't to make you feel bad about how your brain works. Mental accounting is not a character flaw. It is a feature of human cognition that served a real purpose for most of human history. The problem is that it evolved in a world without credit cards, subscription services, or casino chips. It needs a manual update. The first move is the simplest and the most powerful: consolidate the ledgers yourself. When a windfall arrives, a tax refund, a bonus, a gift, before you spend a single dollar of it, transfer it to your regular checking account and let it sit for 48 hours. Don't give it a special psychological status. Make it boring. Make it normal. Because the moment your brain files it as regular money, it automatically applies your regular spending standards to it. The second move is to audit your spending by annual total, not by monthly installment. Every subscription, every recurring charge, every its only expense, multiply it by 12 and write that number down. When you see the full annual number instead of the monthly fragment, you are forcing your brain to evaluate the correct ledger. What you never see in your spending ledger, you cannot spend from your spending ledger. This is why automatic paycheck contributions to savings or retirement accounts are so disproportionately effective. They bypass the mental accounting system entirely by removing the categorization decision at the source. None of this requires perfect willpower. It just requires understanding which game your brain is playing and changing the rules before it starts. I want to leave you with one reframe, one question you can carry into every financial decision going forward, and it's this: if this money came from my paycheck, would I still spend it this way? That question collapses the ledger. It forces your brain to evaluate the money by one consistent standard, regardless of where it came from or what psychological label it arrived wearing. A subscription charge, evaluated against that question annually instead of monthly, becomes a real decision rather than a background assumption. The reason mental accounting is so costly isn't that it leads to dramatic, obvious mistakes. It doesn't. It leads to thousands of small, invisible ones, each one reasonable in isolation, each one quietly compounding in the wrong direction. Your brain is running a money management system that was never designed for the modern financial world. It's working hard, but it's working with faulty architecture. The good news is you don't have to overhaul your personality to fix this. You just have to be aware that the ledgers exist, understand that they are not real, and build a few small systems that treat all your money as one honest number. That shift from emotional ledgers to a single honest ledger is one of the highest leverage things you can do for your long-term financial health. Mental accounting shapes how you feel about every dollar you earn, spend, save, and lose. And now that you know the name for it, you'll see it constantly. In advertisements, in pricing strategies, in your own internal monologue the next time a refund hits your bank. See it, name it, and then decide not your ledger but you. Mental accounting is invisible, it's constant, and it compounds quietly until the numbers get impossible to ignore. Your money brain doesn't switch off when it comes to retirement. That's exactly where these biases cost the most. I built a free tool that shows you the real math, no spreadsheet required. It's called Granary, links in the description.